Folks, we're going to talk about infinite banking. I don't know about you, but this is something I have been hearing about probably for the last 5 to 8 years. It is something that often comes up as the secret weapon to amazing wealth. I'm old enough to remember that things are sold sometimes are too good to be true. I
Mhm.
found a couple of guys, Anthony and Cameron, that talk about infinite banking, have helped people understand it. And I've got a gazillion questions because it just feels icky.
Yeah.
But I got to admit, I don't know what it is. So let's jump in and talk to Anthony and Cameron. How you
Just
guys
feels
doing?
icky. Yeah,
It
we're
just
doing
feels
great, Mike.
icky.
Yeah,
It feels like
thanks for having us.
it feels like one of those salesmen back in the day selling, secret elixirs or something. So why don't you
That
guys
was
introduce yourself first and then define infinite banking, and then we'll get into, is it a scam? Is it real? What's good? What's bad?
I'll tell you, my name's Anthony Faso. I'm a self-described recovering CPA. Uh,
I get it.
after serving in the Army, I went to school for accounting, worked with PricewaterhouseCoopers, CFO of a chain of restaurants, then merged and had my own firm specializing in really small business and a lot of people into real estate. And then '08 happened. Right. And then I kind of realized things aren't working out exactly as my financial planner had intended. And I saw my clients do everything they were told to do. Let's stay out of debt. Let's pay off our house. Let's max out our 401k. Now the 401k is now a 201k. Maybe they're upside down in the house. And to be honest, I really realized I was on that same track. If I didn't do anything different, why would I expect different results? That's when I started asking my clients, because some of my clients actually thrived during that time. And I was like, how are you prepared for this? What are you doing? What books are you reading? What's going on in that mind? And that's when I got exposed. Well, a couple of things. Rich Dad, Poor Dad, but this time I actually executed it. I didn't just, like most people, read it and put it back on the shelf. I'm like, I'm going to start implementing some of this. And then I got exposed to the infinite banking concept,
Okay.
and which we will discuss in a minute. But
Mhm.
then I had my CPA firm and teaching IBC, and I had my family way over here. And my family is why I started my business in the first place. So I had to make a decision. It was easy. And I sold my firm and been practicing infinite banking for over 15 years,
Okay.
and I did 10 years full time.
Got it.
And my name's Cameron Christensen. My background, I was a small business owner when I came across infinite banking. But prior to that, I'd run a small business here in Las Vegas for almost 7 years, and I was late 20s at the time. Got pretty lucky in having a successful small business, so I had a bunch of cash sitting around, and I was looking for places to put it. And I did all the traditional stuff. I went and met with all the traditional advisors, and almost every single one of them told me that I should have an IRA. And I thought, man, am I the only guy that thinks this is insane that I would put my money away at 27, 28 and not touch it till I'm 59 and a half? And I'm like, is this what people are doing? Like, am
Is
I the
this
weird one
real?
here? And so, Michael, I didn't do anything. I actually just sat on cash for a number of years. And
Okay.
my wife and I were buying our house. And I say this to everybody, by the grace of God, I asked our broker if he had a good book for a young couple. And he turned around and he handed me Nelson Nash's book. And he goes, if I would have read this when I was your age, it would have been
Okay.
the difference of millions of dollars. And so I went home and I read that book 3 times the first night. And I was absolutely on fire. And to be honest, I was a little pissed off
Mm.
because on page 44 in that book, he tells you that paying cash is not the best option. And then the rest of the book is really, he just goes through and proves it. And so
Okay.
I spent the next week or so trying to go back into that book and just prove it wrong, essentially. But the next thing I did is I went out there and I looked for somebody to teach infinite banking to me. And I started implementing it personally and then also for my business right away. And so that's really how I got started. The way I kind of became an advisor in this industry is I started sharing this strategy with a bunch of the business owners that I knew. And I just said, hey, listen, I know what your problem is. Your problem is cash flow, right?
Mhm.
And here's some of the things that I've been able to do to alleviate that as a small business owner. And so, that's really how I got started. I've been coaching people in infinite banking for 15 years in one day longer than Anthony. And we partnered about 5 years ago. So it's been great, Michael.
That's awesome. Well, we've said the word infinite banking probably a dozen times so far. Why don't you why don't you do me a favor and define infinite banking first? Which one of you wants to do that?
Okay, if we just do in the simplest terms, what infinite banking, we have to store our capital somewhere,
Okay.
right? And most
Mhm.
people will store it in a bank because it's safe and liquid, right? And
Mhm.
then go and deploy it when an opportunity comes.
Okay.
With infinite bank, and then what happens, you buy that opportunity or that investment that produces some cash flow or profits on sell. You have to put that somewhere. You put it back in the bank and you build up until you have enough to buy another property. And then you do the same thing. You drain that account and buy the property and put that cash flow back in the bank. Uh,
Okay.
and that's what most people are doing. And that's a great strategy. All we're saying, with infinite banking, we just need to add one extra step, because one
Okay.
downfall of using that bank, the main one is every time you withdraw that money,
Mhm.
we're breaking the compound interest curve,
Right.
right? And
Okay.
so, with infinite banking, we're going to do the exact same process, but instead of storing our money in somewhere that's safe and liquid like a bank, we're going to store it somewhere that's, I would argue, safer and liquid. And we
Mhm.
we need to store that somewhere. And where we store it in is a high cash value whole life insurance policy. Now, when we say that, that's when the alarm bells go off in our head,
Mhm.
right?
Yeah.
And
Mhm.
but so we will circle back and address that, right? But let me
Okay.
just explain how this works.
Sure.
Uh, this policy, I say, it's maybe not politically correct, but I say this ain't your mama's whole life policy,
Okay.
right? This is very different. And even when we hear from the people on the radio, when they're talking about how terrible whole life is, they're not talking about the way that we design it. This design is very different, where the
Mhm.
death benefit is much smaller. We have cash value immediately. We have people funding a policy, turning around and taking the money back out in 20 to 30 days. Okay, so we got to kind of the theories or things we have and thoughts about whole life. Many of those are valid,
Mhm.
on that design. A whole life, I don't think is the way it's typically designed is for everyone, but this is designed uniquely. So all we do, instead of funding the money in the bank,
Mhm.
we fund the money in the policy. And then instead of draining our bank account, we
Mhm.
have the ability, we could drain and withdraw the money from our policy, or we also have the ability to leverage against it. It kind of works very similar, Michael, to like a HELOC,
Mhm.
right? Where instead of borrowing against the equity of your real estate, we're borrowing against the equity inside your policy. And what this allows us to do is, for one, you can get access to that money very simple. There's no credit checks. There's nothing's reported to the IRS or the credit bureau.
Mhm.
And then you take that money and buy that same asset. And then instead of putting that cash flow in somebody else's bank, we put that cash flow back in your policy and we build it up again to buy the second asset. And the advantage of doing this are many. The main one is that we never break the compound interest curve. The money is in there continuing to grow
Well, hold
during
on, hold
this.
on.
Yeah.
So I'm confused. So basically, we're taking cash. In one instance, we put it in a bank, call it savings account for simplicity.
Yeah.
The other one, we're putting in a whole life policy.
Hmm.
I get that so far.
Yeah.
Then you want to go buy something. We're calling it an asset here, but it could be anything. You want to take money out for some
Hmm.
reason.
Hmm.
Everybody understands a savings account. Um, but you've already said we could take money out of the whole life policies. I think what I heard.
Hmm.
But then you also just said it doesn't break the compound interest curve. So that doesn't tie in my head. I don't understand that part.
Sure. So what we're doing when we have two ways to access the cash value in our policy. One
Okay.
is a withdrawal, which is the same thing we're doing at a bank.
Okay.
right?
All right.
Or
Okay.
we have the option to use it as collateral, and we take
Oh,
a
so
loan.
debt. Okay. So you're
We
taking.
take a loan from the insurance company.
Mm, okay.
So what that means is your cash value continues to grow. We're
Okay.
not
So
touching
all
it.
right. So let me poke at that a little bit. So okay,
Yeah.
you've got $100,000 in there.
Mhm.
You want 20 grand. You can either take it out, which
Mhm.
does break the compound interest curve, correct?
Mhm. Yep.
Correct.
Okay. Or you could go to them saying, hey, I'd like to borrow 20 grand and use my $100,000 policy as collateral. Do I have that right?
Yep. Mhm.
I'm going to guess that 20 grand borrowed ain't free.
Nope. Let's say
So,
you're right. The interest on that, we work with a couple different insurance companies, are between 5 and 6%.
and what are you earning? What interest are you earning on the 20 grand or the 100 grand in this case? Is it, I have no idea what policy,
What
I mean,
what
is
I
it
would
like a
say,
savings account?
you hear people talk between 4 and 6 or 5. We get to be more conservative. Let's and 4%. Now,
Okay. So
Michael,
you're earning 4, but you're paying 6.
right? And what our
Okay.
mind is thinking, I'm losing 2%,
Yep. That's what I'm
right?
thinking.
Okay,
Yep.
right. Couple things. For one, that 6% or that 5% loan, that's on a decreasing balance, right? Every year or
Oh, sure.
right?
Yeah, you're
So,
paying off. Yep. Yep.
and the money inside your policy is compounding at 4%.
Okay. Sure.
So we could do the math, and if you will actually pay less interest at 6% than you on simple interest than
Right.
you would, but you would earn more interest compounding at 4% for the same dollar.
And how long are these loans? Because obviously I've never done one. Don't know anything about whole life at all. Are these 5-year
Sure.
loans or
Well,
3 years?
I answer that, but I just want to make one
Sure.
other comment. One other
Please.
key piece
Mhm.
is when we use that loan
Mhm.
to create taxable income, we can deduct it.
Say that again. So I'm using a 20K loan in our example.
Mhm.
That is buying an asset that produces in. I didn't get that. Say that one
Well,
more time.
so let's say we use this for the down payment. This 20 grand is a down payment on a rental property.
Got it.
Okay.
I'm with you.
We can treat this just like your mortgage, right? We're deducting the interest you pay on the mortgage, or if
Oh,
you get a
okay.
hard money loan, you know, so same thing. So that
Okay.
5 or 6%, depending on your tax bracket, might really be somewhere between 3.5 to 4.
So the effective interest rate is what you're talking about. So
Yeah.
again, you what I think you're saying is, again, we'll just use simple examples. We're buying 100K investment property.
Yeah.
We're getting an 80K first from somebody, Fannie,
Yeah.
Freddie, whatever.
Yeah.
Then you're getting a loan for the 20. So in theory, you're putting 0 down because you've got
Correct.
2 loans, right?
Mhm.
So the loan on the second, again, is frankly below seconds, right? Because seconds today are 10 or 11. So that's net good, right?
Mhm.
That second's a better source. I don't know how the first is going to look at that, but that's a different story. That's for a mortgage broker to figure out, not my job. But then you're saying the effective interest rate, because you're also going to be deduct the interest payment on the second on your tax return. Is what you're saying.
Yeah.
Okay.
Yeah.
That ties together for me. I get that. Okay.
Do you want to talk about the loans?
The loans you asked about, kind of what's the time frame?
Yeah.
When you take a loan against the policy, against your cash value, is you dictate any sort of loan repayment.
Oh, so
The
you
insurance
can choose is what you're saying.
exactly. The insurance company is not giving you directive on when you need to get this thing paid off. The only thing that they do, Michael, is they give you an annual statement one time a year at your policy anniversary, and they just give you a snapshot of any interest that's owed, cash values, all that stuff. It's up to you, the owner of the policy, to structure some sort of loan repayment schedule. And so that's one of the things that Anthony and I help clients with is, hey, when we take a loan, yeah, it's great. It sounds great that, hey, we don't need to pay anything back. But in all reality is we do need to set up some sort of loan repayment structure. And typically what we'll do is we'll get that set up according to the investment that the client's making. So if it's a rental, we make some sort of a monthly loan repayment. If it's a syndication, it's a quarterly distribution, then some at the end of the year. So that's typically how we'll handle it.
You know,
So I
Michael,
want
what
to
I
make
like to add, this
Mhm.
will be the easiest loan you have ever gotten, right?
Oh yeah, I mean,
There's no
yeah.
credit check.
Mhm.
There's no structured repayment. There's no phone calls. It's not reported on your credit,
Mhm.
right? So
Yeah.
this is why it's important that you're working with a good coach, because it can
Mhm.
be very tempting to not pay some of it back,
Yeah,
right? Because we don't have that structure.
that's where I wanted to go, because what I heard you say, and again, if I heard it wrong, that's why we're here.
Mhm.
What you're saying, you could get the loan, you'll pay interest at 6 in this example, deduct it, net's 4, whatever, I got it. What I think I just heard is you don't have to make payments.
No.
And if you don't make payments, you're going to go backwards, because then you have broken the compound interest curve. You're paying 6, you're only earning 4. That will eat you alive if you don't pay it back. Is that
Well,
correct?
yes, but there's a way. What we would do is, and here's one option: whatever the loan interest is, you could, let's just say it's $5,000. Okay. You could take a loan for $5,000, turn around and then pay the interest of $5,000, because now you have created that tax deduction. So, we haven't really now the advantage, we ideally don't want clients to do that, because if now we're adding it to the loan. Now we're
Yeah,
paying
you're
interest
on
on
debt on
interest.
debt. Yeah.
Right. Exactly. We don't want to do that. But Michael, we know your story.
Right.
Sometimes things do not work out and you
Right.
are in a bind. It's nice to know that you do have that option.
But let me add this, right? Is we did talk about things you don't want to do. Let me take a big picture. Is that
Sure.
when somebody Googles infinite banking, a lot of times you'll see people out there on the internet talking about using policy cash values to go finance vehicles or kind of depreciating assets or even expenses.
For sure.
To be very clear, we're not big fans of that, right? You can make money doing it, but you're not going to get to where you want to go financially by doing that. So
Mhm.
if you ever listen to our podcast, we only talk about buying assets, right?
Okay.
Somebody should be taking a loan to invest into real estate, appreciating, cash flowing investments, and or business are going to be the top two options for anybody. So that's what we recommend.
So again, I'm just trying to piece this together.
Yeah.
So again,
Yeah,
let's
yeah.
be very clear with my audience.
Yeah.
I've heard about infinite banking, as I said, at the open for a decade.
Mhm.
I assumed it was some elixir sold by insurance brokers that
Yeah.
I never gave it the time of day. So what I'm hearing from you guys is if you have a plan, so it really starts with having cash, right? You have cash or liquidity that builds. That goes into this, insurance policy, cash, whatever. I don't know anything about the insurance. Whatever, it goes somewhere. That thing now is an asset that allows you easy in, easy out
Mhm.
access to it. You can borrow against it.
Mhm.
I've heard that. But the magic of this is it's a cycle, right? You're taking it out, you're putting it back, you're taking it out. I think that's what the picture you're trying to paint. I think.
Correct. I mean, really, in the simplest terms, this is where we're storing our capital in between opportunities. Instead of
All
storing
right,
it
so
at a
let's poke
bank.
at that a little
Yeah.
bit. Let's
Yeah.
poke at that a little bit, because
Poke it.
when we talk opportunities, those are investments. So this is not cash that you need on a monthly basis to pay rent or buy,
No.
this week's inventory, right? So it's not short-term money. This is, hey,
Correct.
I'm stacking cash on purpose for something I plan to buy in 9 to 12 months. Is that fair?
Mhm. Yeah.
Correct. Yep.
Okay, so it's not operational cash. It's
Correct.
capital. Okay, got it. All right, so that makes sense to me. Um, so 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 explain the difference between whatever this is called, cash value, whole life, whatever, and this, because I did have an insurance policy. The only insurance policy I bought besides car and home and all of that, umbrella, the only life insurance policy I ever bought, I think they were called term.
Yeah.
And the reason I bought a term policy is I was 25 years old. I had a wife and a kid. I earned significantly more money than my wife. And I knew any investments I was making at 25 really wouldn't pay off till I was 45. So what did I do? I bought a 20-year term.
Mhm.
And I think I forget who it was with because I no longer pay it, right? I turned 45 and we had enough stuff, so I didn't need a policy. Um, what? So I am really naive with insurance. Tell me about a term versus this thing. It's probably vastly different, I'm guessing.
It is very different. So term insurance, it is period specific, which means that you're buying coverage for a certain amount of time.
In my case, 20 years.
Yep. 10, 20, 30 are the most popular, right? So you pay a premium, right? On the 10-year term or 20-year term that you had, it might have been $50 a month at 20 years old, right?
Yeah. It was
So
$100 a year, hundreds of dollars a year. Yeah.
yeah, you pay the insurance company a premium, a small premium, and you get a death benefit. At the end of that, both parties separate, right? There's
correct.
There's no
I got
cash.
nothing.
There's no cash.
Exactly.
There's no coverage. Yeah. The permanent insurance is different. And that's the reason they call it permanent insurance is that when you pay a premium, part of that premium goes to create or to support the death benefit.
Got it.
And then also part of that premium will actually create cash value inside of the policy.
Okay.
And as long as you pay that premium, that policy will be in place until the day you die. That's why it's called permanent.
Okay.
So
Got
the
it.
insurance company can never come back and change that premium amount on you once it's agreed upon, right? Once the policy is in force. So typically our traditional whole life insurance, Michael, is I'm going to start using some jargon. So stick with me here.
Okay.
Is that when you pay a premium, it's called base premium. And that all of that goes to support a death benefit.
Okay. That makes sense.
And that's what Auntie would call your mama's whole life. Right. So you pay a premium, 100% of it goes to base premium, and you've got a big death benefit, and you've got very little cash value, almost nil the first several years.
Okay, makes sense.
With traditional whole life, what you'll see is you will see cash value start to be created in year 3 and 4 and 5, and then cash value starts to accumulate pretty rapidly after that.
Okay.
But there's a slow start. So that's kind of the old school model, right? That's 100% base premium.
Got it.
Infinite banking is completely different. We're not approaching this whole life product from that death benefit or the base premium point of view. What we're trying to do is we're trying to create as much cash value as we can.
Okay. I'm with you so far.
And to do that, we're going to lower the amount of dollars that are going to base premium. So let's take that 100% allocation. Let's take it all the way down to 30 if we're looking like on a dollar. And then what you're going to do is you're going to add on a rider. It's called a paid up additions rider. A paid up additions rider is essentially cash for cash. So if I take $1 I have in my checking account and I put it towards $1 of paid up additions rider, I get $1 of cash value in my policy.
And cash value to the normie like me means access.
Means access. It means you got $1 of cash in your pocket. You've got $1 of cash value in your policy, right? Very similar, but they are distinctly different. I can come back to that though.
Okay.
So where I'm going with this is that when you get an infinite banking design is you don't fall into an infinite banking design. It just doesn't happen. People don't just sell those things, right? Unintentionally. What you're doing is it's an intentional design of where you're minimizing the insurance of the base premium portion, and then you're trying to get as much cash in that as possible.
Okay.
When you do that design, when you look at how that cash value accumulates year over year, what you end up with is you end up with a phenomenal savings account, right? That's earning a great rate, 4% tax free. And then you've got a death benefit, just an ancillary benefit.
Okay.
So that's the design. That's the way that you approach it.
So again, I don't know anything about this. So let's just say somebody's in this for 10, 20 years, then life happens and they pass on.
Yeah.
So do their heirs get the cash value plus what other death benefit there is in this thing?
They don't. So if you get a death benefit, let's say it's $1 million when they pass, they've got $1 million, but they've got 200,000 of cash value.
Okay.
There's no loans against it. Nothing. The individual passes. Individual passes. The beneficiaries are going to get $1 million.
So the $200 cash value, which we've been building, using it for recycled, gone.
Well, I wouldn't say gone because in Cameron's example, let's say there's 200,000 in cash value,
Yep.
and upon death, it's $1 million as a death benefit.
Mm-hmm.
I'd be willing to bet that the original death benefit was probably $700 to $800,
Okay.
800,000. Yeah.
right? Because
Okay.
then
Okay.
the death benefit grows.
Got it. Oh, so it's not a fixed, it's not like you sign up for $1 million.
Correct.
Correct.
You sign up for 750 or 800, and then each year it's increasing, it's growing
Because of the cash value?
because of you're making a payment towards that base premium. You're supporting that death
Uh,
benefit. And then also additionally, Michael, the design that we have is we're rolling some of the dividends and stuff back into the policies,
yeah,
which
you're
makes
paying
it,
it off. Yeah. I
yeah,
got
which
that.
makes it ever
I see.
increasing.
Yeah, so I see all of that.
Yep.
So here's a stupid question. Probably a
Yep.
stupid question, but I'm gonna ask it anyway. Could the cash value ever exceed the death benefit?
It will not, no.
Okay.
So that is called maturity. And what's really happening, if you look at the entirety of a whole life policy, is the cash value is trying to meet the death benefit. And so if you take that and extend it, look at the policy at age 120 is typically when it's going to happen on most products.
Okay.
So
120. Woo!
exactly. Yeah. So
I'd love
reality of
that.
it,
Yeah.
reality of it is that they're never going to meet, right? Yeah.
All right. Okay. Okay. So in my earlier example where I thought the 200 disappeared, it didn't really disappear. It was added. 750 became an 850. And 850 became 925. Okay, I get that.
Right.
That makes
And
sense
then
to me.
let me add this too, is that so we got $1 million death benefit, 200,000 of cash value.
Yep.
In the first scenario, they pass with no loans. The beneficiaries get $1 million. The
Got it.
second scenario, let's say they max loan it the day before passing,
Sure.
and so they would receive the net, the 800 that Anthony was referencing, the difference
Oh,
between the outstanding loan and the gross death
that,
benefit.
that makes sense.
Yeah.
So something I heard you just say, but I'm going to ask the question. So in theory, you could borrow 100% of the cash value. There's
You
not
can, yeah.
like a 50%. Oh, you can. Oh, wow. Okay. All right. So in that example, we borrow 200 grand. I pass. That 200 grand is somewhere. You would hope, not at the casino.
Yeah.
Then you get 800. The beneficiaries get 800. That makes sense to me. Okay. All right. So go ahead.
Well,
You
you
wanted to say
mentioned
something?
you made a statement there that I thought was worth revisiting. Is you said, "Hey, can I borrow against 100% of the cash value?"
Right.
The answer is yes, right? And that's
Okay.
often comes up when people are comparing, when they're looking like, "Hey, this sounds great, but what if I do this?" Right? People have
Right.
investment accounts and everything else. Most of the money's in brokerages, and so
Sure.
they'll compare a loan from from those types of accounts against cash value. If you look at those types of loans, they're very much more restrictive. And typically the first thing that you'll see is you're only able to borrow maybe 50 to 60% of the
Right.
total account value because of the volatility.
Yep. That's my experience. You borrow up to 50%.
Mhm.
Hence the question. Yeah.
Exactly. So when you compare whole life insurance to that, the reason that you can borrow up to 100% is because it's very certain, it's very predictable. The account values don't change, right? We've mentioned 4%, and it's been 4% since the beginning of time, right? It's just
Okay.
very predictable. And you've got a cash account that's sitting there collateralized against it. And so it's worth noting, right, as far as what the percentage of borrowing is against other vehicles.
Yeah. Um, could you flash that book that you showed earlier? Because I never heard of that book or workbook or whatever it's called. What's it
This
called?
is
Becoming Your Own Bank?
Becoming Your Own Banker,
Oh, banker. Okay.
and this is by Nelson Nash.
So I just wanted to write that down because I didn't catch
Yeah.
it earlier. So the next thing I think about this, because again, I got a better picture in my head, right? I am an ex-accountant, econ, MBA numbers guy. So I'm starting to see the picture. This definitely feels like a product where you've got to ask a gazillion questions because I do think there's some suspicion out there when you look at this notion of infinite banking. The other
Sure.
thing I've heard you guys talk about is it's not your mama's policy, I think was the kind of joke earlier. It also sounds like you guys, again, 15 years experience and then 15 years in a day experience. You've done a lot of you've got to do individual, I don't know if I want to call it consulting or consultations or something. Because
Yeah.
is everybody different? I mean, or is everybody the same? Just
Mm.
Different
Let me,
questions.
I'm going to jump in there. Go for it.
Great question. And what I would tell you is everybody's different as far as their situation, but their mentality, if they're a business owner and investor, is almost identical. Right. So they're approaching money or capital from, hey, I want control of this because I can go do X better than so-and-so, right? Is I want to go do this. That's the difference between business owners and investors, as opposed to most W-2 employees where they don't want to handle their finances. They're more than happy to outsource it to somebody else. And so most of our clients are similar in that regard, that they have this mindset of, hey, I want to go do this, but their situation financially is different. And that's where policy design and which company's better suited and all that comes into place.
You know, and Michael, like you mentioned, this, people need to learn this for a couple of reasons. There's some misconceptions that we have, but also they need to understand how and why this works. They need to understand the pros, but they also need to understand the cons. And so we put all of our clients through a strict education process where they see what it looks like at a high level and in theory, and then we go through illustrations so they can see the numbers. And my favorite part, and Michael, I think you would agree, it is,
this is a spreadsheet. What is this?
it is, of course, it's a spreadsheet.
Okay.
Of course, it's better. It's a calculator.
Oh,
Michael, I guarantee you, there's people on this, listen to this, and maybe you're one of them, might be thinking, hey, I always heard whole life's terrible.
Yeah,
I don't need the death benefit.
I do not need the death benefit.
I don't want to go through all this crap. Maybe I don't want to learn this or have to get examined. I don't want to do all that. I just want to buy real estate. Right? Totally get it. But what we do is, let's do the math. What we do as part of our process, we take an individual policy design on their situation, or whatever they want to save. We got to say, we compare it. Hey, we're going to save it in the bank and break the compound interest curve. Or what if we put it in the policy and borrow against it and pay it back? And then we compare at the end.
Yeah, because that's the one wrinkle that was, frankly, it's interesting, right? Because when you kind of explained breaking the compound interest curve and all of that, also we dug into you got to pay it back. That's where it gets kind of interesting. And you're right. You get on a time scale of 20 years. I can see how that, gets pretty interesting for folks. So that was pretty cool. So you have to do that with everybody, because
you know what, that's what I think, right? Because you and me are the analytical ones. Some people aren't like that. I don't think Cameron shows it in every, it depends on the person. Maybe they don't want to see all these numbers, but to me, I appreciate theory, and I'm skeptical of anybody selling me stuff.
Yeah.
I need to see the math. I need to see that my family is going to be better off doing this versus what I'm currently doing.
Oh, and not only better off by a little bit.
Yeah.
Right. It's got to be significant for me to go learn this new thing.
Well, it can be, Michael. And what I would say is, we work with a lot of different investors, whether they're business owners or they're flippers, wholesalers, or a lot of our clients are actually buy and hold more in the long term, where they're buying one rental property a year.
Yeah.
Or something
it makes perfect sense. If you're stacking cash on purpose for an allocation that is sometime in the future, it's not operational cash.
Yeah.
It makes, like, if you're doing one rental at a time, one a year or one every other year, the picture is becoming less fuzzy. So congrats. It's starting to, it is about that compound interest curve. I guess the other question I just came to me is, let's say I sign up for this thing. We're 5, 6, 7 years into this thing.
Yeah.
Life happens, divorce, whatever. And I want to get out of the policy.
Great question.
What happens?
Great question.
Well, we have a lot of options. One of the reasons, there's a lot of reasons why we use whole life for this and not another type of life insurance, because there is a IUL, Index Universal Life, that some people try to use for this. That's a whole nother conversation. But what we like about whole life is we can literally turn premiums off at any time. So like,
Okay.
let's say for the example you're talking about, somebody wanted to save X, let's just say 20 grand a year, right? Then
Mhm.
life happens, they get a divorce, they can't save that anymore. We have a
Right.
couple options. One
Yep.
would be is why don't we just turn the premiums off? So the
Okay.
money's still there, still growing, you still have a policy, you just
Mhm.
can't put any more money in there. Michael,
Okay.
you could also sell this policy, which again is a whole nother interesting conversation.
This is being recorded, Fazza.
Yeah. Well, but you can, right? Or just like you can at a bank account, you withdraw it. You take your money and go home.
Okay, so let's play that out for a minute because
Yeah.
I'm confused with something else we talked earlier. Let's say we have 20 grand in there, like I think this example was, and
Yeah.
we get divorced. We don't have the 20 grand put in there anymore for whatever reason. What you just said is, hey, go get that 20 grand. But based on earlier conversation, now I'm paying interest on that 20 grand, or at least I thought I heard that.
Mhm.
Does this thing ever go negative and just blow up? Or I mean, what happens if you don't pay the interest?
Well, what I would say is, again, that's another risk with IULs where they can blow up. With whole life, another option we can always do if we have this loan
Mhm.
where life happens and we're never going to pay it back,
Right.
we could call up the insurance company and say, you know, that loan, I want to do a withdrawal and pay that loan off. So we always have that ability to write that off. The downside is now we are breaking the compound interest curve, right? So there's pros and cons to it. If it's a permanent problem, we need a permanent solution.
Right.
If it's temporary, then we need a temporary solution. But the
Got it.
point is, there's a lot of life is going to happen. And we got to
Sure.
make sure that this policy works in the good times and also the lean times. And there are options there when life happens and you can't
Yeah.
continue.
Michael,
Yeah, go ahead.
yeah, to be thorough and right is, hey, we're diving into this, so I'm going to share an example with you if that's fair.
Sure. Oh,
Is
that's why you're here.
Yeah, right. And I'm going to highlight something that could be a negative, right? That is a negative that we make sure that we highlight to clients is that when you first get started on this policy, if you're looking at 7 years is the year that you just mentioned, we get to 7 years, we got 20,000 in cash value in there. What I'm going to tell you is that when you first get started, you're not going to have 20,000 in there, right? There is going to be a fee for the insurance piece to this policy.
Makes
And,
sense. Yeah.
and so by that third year, the premiums that go in, you should have a kind of a break even number, which means every
Mhm.
dollar that goes in should be shown up in cash value.
Okay.
But that also means that the first 2 years, you don't have everything that's available to you that you put in.
Makes sense. Okay. That makes
And
sense.
then, yep. And then overall, by the 7th year, the reason I'm highlighting 7 is because by the 7th year, every dollar that you've put into that policy should be available for you in cash value, really close, 7, 8, somewhere in there.
Okay. All right.
So if you get to a point, like Anthony said, where, hey, life goes sideways and you need to stop making premiums, great. You can call up the insurance company. You can shut those off. But again, if it's a permanent problem and you're like, hey, I can't continue with this, I want to be done, you can call up the insurance company and they will send you the entirety of the cash value. So that means you get all your money back, right? There's no fees. There's no charges.
So I want to make sure. So earlier we talked about $1 million death benefit and 200K in cash value. Remember that
Yep.
example?
Yep.
Yeah.
So let's say I'm 58 years old or whatever it is. Life happens, blah, blah, blah. I need that 200 grand. I'm not going to pay another dollar premium. I could call them up, cancel. I don't know if it's called cancel, could be a different word. And I can get that 200K check or wire or whatever.
Yeah.
You could, yeah.
I didn't know that. Okay. That's interesting. Okay. All right. What else do I not, what would help clear up the picture in my head? I'm sure you've dealt with hundreds, if not thousands of folks, bringing them kicking and screaming down this, infinite banking route. What other good things, bad things should we be talking about that I've just missed in my questions?
I got one too. Go ahead.
For one, what I'd say, let's put the death benefit. Once we talk about life insurance, it does alter the conversation, right?
Sure.
But
Makes sense.
I mean, we are fans of term insurance. I have term insurance. Term insurance is is solving the need for death benefit if you need
Yeah,
it.
that's all
Right.
it was.
So
It was
no,
it was a
we
it
have
was a
zero
safety
problem.
blanket for my wife
Yeah.
and daughter. That's
Yeah.
what it was.
That's solving a death benefit problem.
Mhm.
IBC, we're solving a cash problem. And what I would encourage people to do, like you've alluded to, we're just saying we're just replacing the bank. Okay. And not only is this earning a higher rate of return, and now I know the high interest savings accounts have kind of spiked up, but we all remember a couple of years ago when we were getting 0.5,
Yeah.
not
Yeah.
5%. We're going to eventually get somewhere where in the twos to threes. But another advantage with the storing your capital in a policy is I would be I would be concerned about having too much cash in the banking system. Even, I mean, even having less than 250,000, the FDIC,
Mhm.
I do have some concerns if they will be able to properly fund everything. But your money is safer inside an insurance company.
That's a pretty
Also,
bold. That's a pretty bold claim. Why is the insurance company magically better at
Mm.
protecting money than the FDIC?
It's
okay. Well,
it,
man. Okay. Well,
we're both chomping at the
yeah,
bit. Yeah,
in
go ahead.
2000, when that last banking crisis, what a lot of people don't realize, in that bill, it says we will know, they're calling it a bail-in, not a bailout.
Yeah. So so okay. All right. So no more bailouts. It'll be a bail in. Everybody loses. Got
Yeah.
it. Okay. All right.
If that really happens. But here's an interesting fact, Michael. Do you know how many banks failed in 2008?
Oh, I don't know, 1,000 banks, something like that.
499.
Okay, so 500. All right.
You know how many mutual insurance companies failed?
No idea.
Zero. The companies we use are over 100 years or older, pay dividends every one of those 100 years. So they paid dividends during the Great Recession and during the Great Depression. And one of the biggest differences between safety is there can be run on banks. Banks only can use a fractional reserve where they only need to have 10% in there.
Yep.
Insurance companies do not have that privilege. They are unable to do that. So when there's a run on the bank, that happens constantly. I mean,
so the insurance company's got to be putting that cash somewhere. They're not just sitting on it like, some rich banker. They're buying, I'm going to guess they're buying commercial buildings. I'm guessing. I mean, they got to be putting the money somewhere.
they're buying many different assets.
Sure.
A lot of them are going to be interest rate sensitive, whether they're buying bonds. But when they buy a 30-year bond, they're not trading it. They're holding
they're just
it.
hold maturity. Hold to maturity.
Right. Yeah. They're buying commercial buildings in cash.
Okay.
If you get money out of somebody's gotten a loan, bought a car from Ford, right? And maybe they got a loan from Ford Credit. Ford doesn't have a bank. Where are they getting that money?
Okay.
They're buying it from insurance companies. And you know where else the insurance companies invest their money? Is policy loans. Because you take that loan to buy that property, that is an asset on the books of the insurance company.
Makes sense. Okay.
Were you going to say something, Cam?
Yeah, you mentioned, I won't add on to that, but I'll go back to your bigger question, right? People come to us all the time. What do we need to know? We've kind of skirted around it, but I'm going to address it here. We've done a whole podcast on this and we've mentioned it several different times, but as you go down this infinite banking road, or even if you just kind of pull the curtains back and peek at it, you're going to have to get really good at distinguishing fact versus opinion.
Okay.
When you get out there on the internet, right, you're going to get everybody's opinion. And I did telling your listeners, just be ready for that, right? Because everybody's going to tell you how bad it is, everything else, and you've been preached your entire life.
Yep.
What I would urge the listeners to do is go out there and do your own research. I'll say this: infinite banking is not for everybody, but for the people that it's a good fit, it's a really good fit.
Well, all right. Let's talk about the avatar, because I actually like the idea that you will admit it's not for everyone. I think that's, because lots of salespeople say it is for everybody. Let me just tell you why. So I like the fact that you say it's not for everybody. So who is the avatar? What type of person should look at this? Is it the self-employed business owner? Who is the person that should, reach out to you via phone or email or website or whatever? Who's that person that should go a next level deeper?
A couple attributes that person, they need to be teachable,
Mhm.
because this is a different concept. If somebody thinks they know it all and we try to show them a different way, it's not going to work. This is ideal for people that are good savers, right?
Okay.
We can't teach people how to save and live below their means. So
Yeah.
it's people that,
Back to that operational question. If you're just churning your capital or your income every month, it's not going to work.
No.
yeah,
Okay.
but
All right.
somebody who
And sorry, and there's a lot of people out there claiming that it will in our space.
Oh,
Is
I'm
there
sure.
yeah.
Yeah.
So yeah, go ahead.
but if somebody has some capital and they want to use it to buy assets.
Mhm.
I
Slow
mean,
and
so
steady. Back to your
yeah.
earlier
So,
point.
and
Okay.
I meant to, I didn't finish my thought earlier. This works very well with investors. And whether you're a flipper again or a wholesaler, this is ideal for somebody who's buying one rental at a time, where we're
Okay.
not trying to overuse it. We're just storing the money at the bank. In a policy, as opposed to the bank. One additional attribute I wanted to mention is every state's different, but most states, Nevada being one of them, Texas, Florida, and even New York, 100% of your cash value is protected from lawsuits.
Oh.
So a lot of our investors, if you've been around long enough, you're going to get sued, right? So there's ways to tighten that up through trusts and LLCs, but even though there's still some room there, but you can have your money that you're investing in that is protected from lawsuits.
I'm gonna add on to that. Michael, when we just interviewed this gentleman on our podcast, and he's one of my favorite CPAs.
Was it me?
No, it's not you.
No.
You're top 10. It's Tom Wheelwright.
Yeah, Tom Wheelwright. Yeah, rich dad guy. Yeah.
Oh, okay.
He wrote Tax-Free Wealth. The reason that I love this guy's approach, and I recommend his books as many times as I can, is he's not out there telling everybody, hey, infinite banking is the greatest thing out there. He goes through and he kind of gives an honest overview of opportunities. But the reason I'm tying him in here is because he starts with the end in mind. And he says what happens with most people is that they will go throughout life and they'll meet with an advisor here, they'll meet with an advisor there. They end up with a Roth, they end up with a traditional 403, all these different types of accounts. They get to the end, they're like, crap, what the heck do I do with all this stuff? Like, none of this is cohesive, none of it makes sense.
Right.
And so you're asking kind of who the avatar is. And what I would tell people is that, man, write down your goals and start with the end in mind. What are you trying to get accomplished? And if your goal right now, today, right, is, hey, I want to buy real estate, or even more importantly, I want to create cash flow or income now today that I can live off of, man, you got to look at infinite banking. Infinite banking is a great pairing vehicle to work with that. If you look at every other retirement vehicle that's out there, very difficult, almost impossible to take income out of those vehicles for you to live off now today. And so that's where most of our client base is they say, hey, I want to create income now today. Well, great. Well, we can't do any of the regular stuff. We've got to run our money through a policy. And now what's going to happen is you're going to be much better off. So I hope that helps.
Yeah, there's just a lot here. We've only touched on probably 1%, maybe even 0.5% of what infinite banking is. I have at least a little more clarity on where it could work, given that, borrow, pay back. That was enlightening to me. If somebody wanted to go a little bit deeper with you that watches this, because again, we didn't go nearly deep enough in this hour together, where should they go to check you guys out, to poke around? What should they do?
Well, we got a great opportunity and great offer for your listeners, because I would imagine some of them maybe they heard whole life and exited out. So
yeah, they
sorry,
turned off.
right?
Watched it.
My apologies.
For the two of you that are still on, we got a great offer.
But if you're
funny.
still on, you are teachable. And you know, do your research on infinite banking. Well, don't just take our word for it. Look as many areas as you can. We want you to understand this, because the people who understand it will do it. And as you're doing the research, like we alluded to, some people are saying this is a scam, the worst thing ever. Some people, this is the best thing and is going to cure all your financial woes. Neither one of those are accurate. To be honest, it's somewhere in the middle, right? I view this, the real wealth is going to be built by buying assets. But I view this as my rewards credit card for buying those assets. I just add one extra step. Instead of a credit card, I use my policy. Instead of getting miles, I'm getting compound interest that I can turn into tax-free cash flow in retirement. So the people that are still on this podcast, I would encourage you to go learn more. You can do your outside research, read Becoming Your Own Banker. We also have an online course that talks about IBC at a high level, and it also does that calculator, Michael, that I had talked about, using cash or storing money at a bank or storing money in a policy. All we encourage you to do is to find out for yourself. And you have this free offer. We normally charge about $1,000 for this course. You can come in, look at it. We're not going to call you. We're not going to bother you. You don't need to talk to us. But it's if you're a real estate investor, particularly you're buying it one real rental at a time, you owe it to yourself to evaluate IBC. Then you say, you know what, this ain't for me. I'm not in. Sure, it's not for everybody, but more than likely, it's very possible that it could be. And that still, the next step would be is let's get on a phone call with us, make sure that it is right for you. Hopefully we conveyed, we're not your sleazy insurance salesman. You know, I'm a recovering CPA and this guy has silky smooth hair, right? So all we want to do is teach this, and you have this opportunity.
Yeah, Michael, is Anthony went a long way to say that they can go to this landing page and they could find more information. If they go to infinitewealthconsultants.com/one rental at a time, that'll give them access to the course for free. They can go in there and look around. And like I said, we're not going to call you, but there's a bunch of educational stuff in there. So we'll make sure that we get that to you and you can put it in the notes.
I love it, guys.
And we're on all social media channels, Infinite Wealth Consultants. We'll send you our link tree so they can find our podcast, YouTube channel, link to the course.
Yeah, I just love the fact that you guys know that you're in an interesting space with lots of charlatans. That's got to be both fun and frustrating, I'm sure, right? When you hear people in your space using your words being scumbags, that's got to be frustrating.
It is.
You come at this, at least as far as I can tell, from an education and hey, it's not right for everybody, which I appreciate. So I appreciate you answering all of my questions, the dumb ones and the good ones. Any last thoughts as we wrap this up?
Last thoughts. I would.
I shared my last thought right there. So.
I got one. I got one for you. Is we're talking about kind of this space, right? Investing, financial education, and this is one of the things. My favorite things I tell my kids all the time is that as you start to get into this world, you realize that a lot of times this industry will use words interchangeably, and they mean something drastically different. And that is a huge red flag. And so if you're out there, you guys are listening, is you need to know the difference between saving, investing, and speculating. So saving, in my opinion, is an action verb, right? We're putting money away somewhere safe every single month. It's a habit. It's like working out, right? You got to do it. Investing is where there's a level of due diligence that takes place way before a dollar is ever inputted or spent on that investment. The third one is speculation. Speculation is where you're just throwing money at something. You have no clue, right? And it's just pure hope and prayer that it's going to turn out for you. And what you'll find is if you start categorizing some of the investments that you're making based upon those three activities, you'll find that most people are by and far speculating with a large majority of their investments. And so that's what if somebody's listening, man, write those three words down, go and categorize what you're doing, and then remember that stuff. And when you're presented with an opportunity, hey, are you doing the research that needs to be done before you make this investment? Or are you just writing a check and hoping this thing works out for you? So that's what I would leave the listeners with. Yeah.
Anthony, Cameron, thank you for coming back. Thank you for answering my questions. Amazing. One more time. What's the website they go to?
They can
Kevin?
go to infinitewealthconsultants.com. We'll take them to our landing page. And then if they add a / one rental at a time, that'll take them to the course.
Awesome. Guys, you're amazing. Thanks again.
Thanks, Michael.